In this video, traders, we're going to look at other ways to manage risk. Stay tuned. Hey guys, warm welcome to you. Okay, so the obvious way that we manage risk is obviously with a stop loss, right? We say, okay, I don't want that thing to go 200 pips against me. I'm going to put a stop in at 200 pips. Goes 200 pips against you, bang, you're out of the trade, you move on to the next one. Now, that might not always be the best way to manage risk. For the majority of positions, it probably is. It's probably a level where the trade is negated. It's the whole point of a stop. It's like, hey, you know what? When the trade gets here, the likelihood is that the trade is no longer working, the thesis is wrong, I need to come out. But there are some trades where your thesis relies on perhaps other markets or other conditions, and price isn't always the final thing that you're looking at. Maybe it's relative strength, maybe it's kind of the short float, maybe you're waiting for something over earnings, who knows what it is. But sometimes there are scenarios where, hey, you know what, price isn't it. Now, okay, I know that some people are saying, well, of course, if you're down massively, you've got to come out because you're losing money. Yeah, I get it. But there are times when you maybe want to stay in the trade because you think it's still a good trade, but you still want to kind of manage that risk as well. So let's look at some different options we've got. Okay, the first one is to hedge. People think, well, hedge, what do you mean? Is that something for the hedge funds? No, that basically means, okay, if we are long something, then we can short another correlated asset. And so we're still ultimately long that instrument, but we've hedged our position. Example could be, let's say we are long NASDAQ. Okay, we're long the NASDAQ and the NASDAQ's falling down now. We're thinking, well, you know, we think tech's going to recover. We think earnings are going to be really good on Apple, Amazon, whatever it may be. That's going to give Amazon, it's going to give NASDAQ a boost. NASDAQ's falling lower and it's a level we don't really like. Now, what we can do is we could short like the S&P 500 or the Dow or something like that. Now, are they exactly correlated? No, because the tech is different to the constituents in the other indices, but there's some correlation there that if the whole market's just flowing down because there's panic or whatever it may be, you're going to be somewhat insulated from that, because I think tech will probably more extreme moves than the others. But let's say, you know, the market gets hammered, then you're going to lose on your long NASDAQ, but you're going to gain on your short S&P 500. And the theory is then, if your thesis is right and we start to push back up in tech and tech outperforms, then that short will lose money, but you'll make more money on your long. So you could do it with DAX FTSE, you could do it with a CAC DAX, you could do it with, you know, any currency pairs that are correlated, maybe commodities against currencies, maybe two commodities like gold and silver. You know, it's up to you to see where the hedge is. Obviously, you don't want a kind of direct hedge because you may as well come out. There's not really any point in selling, you know, if you're long S&P 500, then you go short SPY, for example. That's almost like coming out because they're identical. But you get the point. The idea is if you can do something that hedges you a little bit, maybe with individual stocks. So say you're in tech stocks, it's a couple of tech stocks. Say you're long a tech stock, market goes lower, you perhaps can hedge a very similar stock to insulate you from the market and still give you the upside that you want if the thesis of the trade comes true. So that's one way of doing it. Another one is an option. So you can buy or sell a call or a put option. Now, don't need to go like in multiple details of different strategies with this. I've done quite a few videos which talks about call options, put options and all that kind of stuff. But in reality, you can basically, hey, the market comes lower, you could say, well, actually, you know what? I might now buy a put option that protects me if we go way lower. Hopefully the put option will expire worthless. I will rally and that will become worthless and I'll just lose the cost of hedge. But if we ultimately keep going lower, at one point I'm going to be kind of fully hedged, but I'll still be in the deal. So it dampens off a little bit. In other words, the market goes lower, you make money. Market goes higher, you're going to lose a little bit. But then if it keeps going higher, at some point you're going to stop losing money on the call option because it goes to zero and allows you to get that full kind of move with the long stock or the underlying asset. And you can also sell options as well if you want to kind of mess around that. So there's lots of things you can do with options, and they're quite a good hedging strategy, especially against extreme moves, unusual moves, that kind of stuff. One way you could hedge, quite a lot of people use options to hedge against a portfolio risk is, hey, you know, they've got a basket of stocks, they're doing well. Perhaps they're a little bit cautious about the up and coming quarter for the market, so they might buy some put options on the S&P 500 or on SPY, which is the S&P 500 ETF, or something like that, the Qs, which is the Nasdaq ETF. So basically, if the market does start to plummet in that quarter, they're going to make on the put options they bought. Yes, they're going to lose on the portfolio, but it's going to add some. It's going to really kind of make the damage less because they're making on that. So that's something that the hedge funds will do. Or they might sell call options, for example, where they're getting some premium as well. So there's little things to consider there. All right, the other thing is VIX. Now, this really is a volatility component of your S&P 500 options. Now, what the VIX does is it basically allows you to say, okay, if we are perhaps going to go into an aggressive bear market, VIX will spike. So you might buy a VIX ETF like VXX, you might buy VIX call options, you might buy something like that that allows you to profit from volatility increase. This is not fully related to the actual underlying asset you've got, but the thesis is, let's say you are long and you think, well, if a volatility is low, let's say the market's been chugging, buying some VXX or buying some VIX call options is basically saying if the market suddenly has an extreme move to the downside, VIX is going to spike. I'm going to lose some on my long portfolio, but I'm going to gain it on my VIX. Now, if it just rolls over slowly, VIX might stay the same. So you've got to weigh that up and adjust that to suit. And it might be the other way around. Maybe VIX has spiked and you're short. And let's say you want to go short VXX. So you're short the underlying and short VXX. In other words, if the market pops back up, the VIX may well compress in price. You'll gain from the short, you'll lose on the short underlying you're trading, the asset you're trading. Maybe you can then cash that in and then it rolls back over instead of having an actual stop because you don't know how far that short covering rally might go. So there's different flavors and ways you can do that. And obviously it depends on what you're trading. If you're trading a currency, it might not be, there might not be no correlation whatsoever with the VIX and the currency you're trading. Probably not. Or they're saying that dollar with the US indices, maybe. The other thing is to close a portion. So rather than just closing the lot, you can just close a portion of it. So you can say, you know what, at this level, I'm going to take off a third. I'm going to take off half, I'm going to take off a tenth, whatever it may be. Sometimes that just eases the pressure a little bit. You're not in a full position, you've kind of taken some off, you feel like you've taken some action, you've done something. It's actually very, very powerful to do that. And you can have different levels where you're taking some off, which means that you're in the least possible size when the market's going against you, and hopefully you're in the biggest size, you add it back on when the market's going in your direction. That's the theory of doing that, and that's actually quite, it's a relatively easy thing to do. It's not, these are sometimes a little bit more complicated perhaps with the option VIX, but closing a portion gives you that little, okay, well, I'll take a little bit off, damage is less, and as it goes lower, I'll peel some of the position off rather than all in or all out. The final thing is size. So instead of actually having a stop or managing risk, you can just trade a size that allows you to sit through these big swings. Example could be, okay, well, I'm trading, swing trading. What's the quarterly average range, or what's the monthly average range? And if I have a size that allows me to sit through a whole range that's the average or the most likely in the quarter or the month, then you're going to be okay. You're not, unless it goes extreme, of course, and you must have some kind of ultimate, hard risk management in place. But you can sit there and go, well, I'm going to let the market go back and forth swing because I'm in a position size that's not going to damage me. And then you could perhaps add to the position when it's going your way and you can adjust it. So managing risk with size, i.e. putting a small position on that's not going to damage you even if it goes a full move. Example, if you're day trading, if you've got a daily ATR, the biggest ATR, the biggest range you've had in the last 2 months or something, and you're prepared to stomach that, then you can trade without a stop because you know that, hey, worst case scenario, I'm going to lose this. Am I comfortable with that? Fine. Now, does that reduce the expectancy of your strategy? It may well do, but it's an option to consider. It's something to look at and go, yeah, you know what, if I trade small enough, I can sit here and I can adjust and adapt. I can add some on, I can take some off. I can just be a little bit more nimble and adjust and tweak and play with the trade. Peel some on, add some off, take some off, scalp with the moves, and keep an underlying core for that fundamental or kind of underlying trend that I'm trying to capture. So that's one way of looking at it as well. I guess the final thing is pray and hope, but hopefully no one's doing that. That's not really an effective risk management strategy. Anyway, guys, hedging, options buying or selling, VIX, closing a portion or dealing or trading in a size that's reasonable for the range and the volatility, expected volatility of the instrument that you are trading in. All right, guys, take care. Bye-bye.